It's 4 o'clock in London. It's 12 o'clock midday in New York. By the time you're watching this, ladies and gentlemen, we're actually recording slightly earlier in the morning. It's 3 a.m. in Sydney, 9 a.m. in San Francisco, 9:30 at night in Mumbai. Greetings. Good morning, good afternoon, good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO-VID live stream, series 35, episode number 1. That is in the aggregate. Episode number 205 starts here. In the world of exchanges, lots happening. Interagency kumbaya between the SEC and the CFTC appears to be hitting new highs. Will Chairman of the SEC, Paul Atkins, go further and adopt a greater principles-based approach? We wonder. NASDAQ tokenomics have taken a leap forward with the embrace of the country club's listing duopoly. NASDAQ focusing on issuer dynamics for their brave new world. NYSE already rolling out their token dynamics in recent weeks. A case of bro shock. Legacy markets are taking their real world assets back. Meanwhile, NYSE Texas is ready for primary listings, while NASDAQ is already a go-go with their offering. Where does this leave cash rich but listings poor yet to launch Texas Stock Exchange? Meanwhile, a case of EU euthanasia is afoot as the biggest Euro economies vote for a mono regulator, which appears to be endorsing a mono bourse, aka the European Union could soon have fewer free markets than communist China. Finally, today, plaudits to the great folks of Connemara EP3, who have announced a fascinating software testing venue with Exact Pro in that venture. That brings us elegantly to our NASDAQ sponsored segment. We're talking about their wonderful tokens earlier on. The good folks of NASDAQ, well, what do they want us to know today? Investor appetite for Asia is rising, but post-trade friction is holding markets back. In the new NASDAQ Plus Value Exchange study, 25% of participants plan to grow exposure, yet 46% face artificial trading limits, the biggest pain point. Corporate action, 60% report high error rates, and 39% of platforms are still legacy. The fix is clear: harmonized rules, standardized workflows, modernized technology in order to unlock efficiencies in settlement and corporate actions. For exchange leaders ready to scale, download a copy of the report, Creating Asia's Post-Trade Operating Model of Tomorrow, at bit.ly, APAC-post-trade. Let me spell that for you. Bit, Bravo, India, Tango, Dot, Lima, Yankee, then APAC, Asia Pacific, of course, being the code, dash post-trade. That's post-trade with 2 T's. Our guest today is Lee Freeman-Shor. The topic, stock market maestros. Leading fund manager Lee Freeman-Shor has managed billions and nowadays brings his wisdom to the crowd through acclaimed books such as The Art of Execution and his latest tome, the topic of today's discussion, Stock Market Maestros, the winning habits, strategies, and mindsets of the world's best investors. Lee, welcome to the show. Good day to you. Where in the world are you today?
Thank you for having me, Patrick. Today you find me in Tel Aviv, ducking and diving between the missiles.
Yeah, what is it like there at the moment?
You don't get much sleep because the Iranians and Hezbollah seem to fire the missiles in the evening. Well, I should say in the early hours of the morning. So sleeping fortunate to have an apartment with a built-in bomb shelter. So find myself sleeping there at night time and doing and running there regularly during the day. But apart from that, it's life as usual, strangely enough.
Yeah, it's remarkable how conventional life can be at these times of acute stress. But obviously, that's a great concern for us and for all of you who are living in Israel at the moment. We express our concerns and also hope that this will manage to resolve itself in the nearest possible future, and hopefully with a better regime for the good people of Iran in particular. So Lee, tell me a bit about yourself, because I detect an English accent there. So where do you come from originally? What is your origin story? How did you get into finance?
God, well, I'll give you the short version. So you're right. I am a Brit. I'm an Englishman in Tel Aviv. It's because 30 years ago I met my wife at law school. We did law together and married her, and then 5 years ago we moved here to live after living in the UK. How did I get into finance? I think by pure mistake would be the true answer. Left school, wanted to be a chef, did it for a couple of years, didn't like the hours or the pay, and then decided I should probably listen to my parents and gone down the education route. So hence why I went to university law. Didn't like law, and then I kind of didn't know what to do. So I became this is at the late 90s when you had the just before the dot-com bubble. I became an independent financial advisor, and it was there that I sort of like took a liking to the investment side of that job, because you do pensions, investment, mortgages, insurance, all that kind of thing when you're advising people. And so I started to focus on the investing side, and then eventually went from private client into the institutional world, but in a more, if you like, distribution, business orientated role, and eventually moved on to research and fund management. So it's not exactly a planned route, not your traditional MBA, CFA kind of economics route to finance. So did a lot of learning and studying on the job. Fortunate to have some great people that who mentored me and I learned from. And I obviously in the end did quite well. That allowed me to step back from running money in 2018. But during the time I was running money, I managed a couple of billion across European, UK, global equity funds, and 5 multi-asset funds. So yeah, that's hopefully me in a nutshell.
Fascinating altogether, Lee. So therefore, I mean, somewhat of a lot of life experience before you managed to get into the world of investment management. I think that must be a very interesting process, though, because therefore you weren't born kind of inured into financial markets. Did you find anything particularly surprising when you got into the world of fund management and so on via the IFA route?
Surprising. I guess people were more surprised. I guess there's you have a perception of to be successful in finance, you've got to be unbelievably intelligent and fantastic at maths, and I'd say I'm neither of those things. But I was fortunate to have a team of quants that supported me running money. But I think this is what I discovered is, I managed funds, and I also managed a team of investors as well that managed my funds were team managed, and I managed the guys in my funds. And I think what I used to find surprising was some of the, there's no correlation between the amount of education or experience a person has and their success in markets, which I'm not sure if that's good or bad, but you'd kind of think, someone that did an MBA, at Harvard, say, or Cambridge, and CFA, you'd think they'd probably have an edge versus everyone else. But I certainly didn't find that in the markets. In fact, a lot of the most successful people I've worked with and hired, I'd say education was not strong on their CVs either. So I think that was the most surprising thing. I think you have a perception that a lot of people, if you're from like me, the 80s movies dominated your mind, like Trading Place and things like this. And you have a perception in your head that to be successful in markets, you have to have some kind of Midas or golden touch. People are, just gifted and born with it. And I realized that actually a lot of successful investors, it's not due to that. It's to do with hard work and discipline and strategy, which can be applied by a lot of people. I think that's where most people go wrong. They just lack the discipline and they lack a strategy, and they try to, they punt ideas here and there. And I think that's where people go wrong. And what I would say, the point of my first book, Patrick, The Art of Execution, was I wanted to share with the world what I thought at the time, and still do, was the most shocking finding ever, where I managed a range of funds called Best Ideas, where I hired the best investors in the world. Literally, I had the best investors in the world. It's like the Real Madrid of teams that I managed, billionaires, very successful guys. And I gave each of them $25 to $150 million to invest, and I managed them. And I gave them, there's one rule, which is, okay, here's some money, invest in your 10 best ideas. And the rationale was based on a study by Harvard and London School of Economics, whereby they showed that the bulk of a fund manager's returns come from a handful of names, their 5 highest conviction ideas. So we thought, okay, wouldn't it be interesting if we could get the best investors in the world and just get them to invest in their best ideas? We're going to make a fortune. What could possibly go wrong? And what I discovered was actually it was a toss of a coin as to whether their ideas made money, which shocked me. You know, the actual 40, you know, it's a 49% hit rate for any idea making money. And that should shock any of your listeners out there. I mean, you're talking about super experienced guys, very successful, investing in their 10 best ideas, and it's a toss of a coin whether any makes money. So when I discovered that, obviously that led me to sort of look at some of them and go, well, what is it that makes them successful if it's not the stock picks or the ideas per se? And there was one guy in particular I focused on because he had a 30% hit rate. So only 1 in 3 of his ideas made money. So on the face of it, you'd go, this guy's crap. But you know, he was my best performer. So his P&L, he was making a fortune. So I was like, is this guy just lucky? What's going on? And what I discovered by analyzing every single trade he did and every investment he went in, I discovered that he had certain habits of execution that he did when he was losing and winning. That meant that when he lost, he didn't lose big. And when he won big. And obviously, he's only winning 1 in 3 times. You have to win big. And I sort of say, okay, so he's doing these things when he loses and wins. I wonder if that applies to the other investors I've hired as well. And when you look through that framework, I discovered that actually all the successful investors had these common habits of execution that they did when they were losing and winning. And ultimately, I was able to boil it down to investors falling into one of 5 tribes. And depending on which tribe you fell into determined your success, basically. So, that's, I guess, a long-winded story about surprises. But, it sort of explained the first book.
Yes, it's very, very interestingly, isn't it, when you look at what's been going on in the marketplace as a whole, because particularly I think markets actually as a whole have lost quality in the course of the last 20 years, precisely because they have gone towards a particular graduate quantity mathematician type. And you and I can remember the freewheeling days of the 80s and 90s when quite literally all human life was there. And I always remember Paul Gallico, when he was a famous novelist, he used to still report on Saturday baseball games, and he used to sit in the bleachers writing his report by hand. This was long before digital devices. And he would be sitting there writing the report, and literally kids are jumping up and down, screaming around him. He's getting ketchup from hot dogs and mustard squelched all over his notes. And people would say to him, why are you doing this, Paul? You don't have to afford to be there. And he said, because all human life is there. And I've always thought that's a great definition of markets, because when all human life is not there, you've actually got an anomalous market. There's something wrong. And I think there is something to be said that 1980s, 1990s zeitgeist, it had amazing people, the White Sox guys from Essex, all the way through to, we're going to talk about him in a minute, the late great Professor Desmond Fitzgerald, who died just last week, really started the whole risk management movement in London in a quantitative fashion. And it is interesting how that the actual raw level of intelligence doesn't really seem to matter per se in investment success.
Yeah, it's shocking but true. I mean, it's I think emotions, or being able to control your emotions, is probably the key factor. Discipline, emotional control, and I think that at least I saw that in real life actually with my investors. And if I go back to the Art of Execution book, when someone's losing, they'll fall into one of 3 tribes. They'll either become a rabbit, a hunter, or an assassin. Now, the rabbit is what you don't want to be. They were my unsuccessful guys that I ended up firing. But I learned a lot from them, because what did they do? Well, like a rabbit, they dug holes so deep they couldn't get out of. And also, like a rabbit, when you'd chat with them and say, look, you're down 50%, and to break even you need 100%, and you've done nothing. What are you doing? They'd be like a rabbit in the headlights, and they'd be like, well, they're finding all kinds of reasons as to why they didn't want to do anything at that point, why they didn't want to sell, why they didn't want to throw more capital at the idea, and hence why I called them rabbits. And one thing you realize is when you're being a rabbit, you end up embracing the left tail risk. You end up with some big losses, and that just skews your whole portfolio the wrong way, and it means overall you end up doing a bad job. But the central thing behind all that, it was very clear, was emotions. And I think why it was so obvious to me was because these guys, in my world, they're running 10 stock mandates. That meant every position was on average 10%. Some of the guys had 25% positions. But if you compare that to their main funds they're running for their investment shops, they may have 50 or 100 stocks. And I'd often have a chat with some of the ones that really struggled, where they'd be going, "Oh, this is a 1% position in my fund, and I don't really have to think about it. But here it's 10% here, and it's, oh my God, I've lost, it's down 50%, so I've lost 500 basis points." Oh, and you could tell that just the sunken cost bias, the endowment bias was influencing what they were going to do. It really was screwing them over. And they were talking about really experienced guys, very successful guys at running broader portfolios. But when you got it down to a more focused, just investing your best ideas, when those best ideas went wrong, think about it, they've got ideas that they're very confident in as well. Psychologically and emotionally, you can see they just went to shreds, some of them. And it's amazing to see that. Yeah, so that emotional control, discipline are far more important than I would suggest the intelligence level.
Yeah, and it's also interesting, though, because as you say in the book, which was our book of the week last week in Exchange Invest, actually, ladies and gentlemen, for those of you who were watching, it's a very, very interesting balance, because you can make yourself a better investor even without having an information advantage, just by executing. And ultimately, and this is the thing, actually, you talked about the films, the movies miss, because the movies make it all terribly glamorous, whereas actually doing it properly is mind-bogglingly boring after the fashion of the most bureaucratic civil service on earth.
Yes, the boredom thing is a good one you hit on, because so the new book, Stock Market Maestros, the point of that is a sequel to Art of Execution. And the point is, people wanted to see, okay, so I read the first book and you said, okay, if I'm assassin when I'm losing, which means, cut your losses before they do too much damage. That's a winning trait. But then I'd get people pinging me back and forth saying, I'm losing, I'm down sort of like 30, 40%. What should I do? I don't want to sell, I don't want to add. And I thought, well, if we do a new book and we introduce them to actual 12 award-winning mega successful investors, and we can have case studies in there of stocks they've invested in, they can see what these guys do when they're winning and losing. And then maybe they can pick up some tips, if you like, what influences this guy to sell or buy. And when you said, it can be very boring, I'm reminded of one of the investors, James Hambry. I mean, you'll know him in the UK, legendary hedge fund manager.
Yeah. Came
to fame in 2016 from making 100-odd million from positioning his portfolio to benefit from the UK leaving doing Brexit, leaving Europe. And but if you look at him, one of his big winners, one of the case studies in the book is Plus 500. It's a name he's been in since 2013. So if you think about that for a start, he's been holding it already 13 years, which I would argue 99.9% of investors will not have done. Yeah. Most have a time frame of 3-6 months, maybe a year, maybe 2 years. The sell side never look out further than 2 years. It's mainly a year at max. But because he's been able to have that long-term lens, he's made over 6,000% total return from that name. 6,000%, combination of dividends and capital returns. And and he talks about how he's able to handle that, because that's also a name where there's been points where it's gone down 50, 60, 70% and back up. And so how do you handle the boredom of not just staying in that name for so long, with the story playing out, nothing new, if you like, and also psychologically, emotionally, how do you handle those downturns? And so they're the kind of insights we try to give in the new book, Patrick.
No, that's really interesting, actually. I mean, not wanting to get into the depths of Plus 500 per se, but you do mention, I mean, that is a mind-bogglingly volatile stock. It has had a story that could have had Netflix could have quite happily taken the rights and make a great mini series out of it, because it's been through 2, 3, 4 colorful owners. It's had all sorts of incredible successes, amazing setbacks. It's been accused of all manner of things. I'm not saying what's true or what's not true. I'm not getting involved in that, but the market action has been absolutely crazy altogether, and that's incredible. Yeah. So, I mean, talk to us then, about this new book. It's really interesting. So it follows on Stock Market Maestros. It's coming out. Well, actually, it's just come out, I think, if I'm correct.
Just come out 2 weeks ago. It came out. Yeah.
Excellent. 2 weeks before St. Patrick's Day. Perfect gift for anybody if you're looking for something for St. Patrick's Day. May I also offer you, as a Patrick, a very happy St. Mea's Day. As an Irish Patrick, may I please invite you, no matter where you are, what religion, creed, or whatever else you follow, please culturally appropriate something Irish for today, ladies and gentlemen. You are welcome to feel as Irish as 23 DNA and me, or whatever those tests are. Say that you're not. It doesn't matter. You can be Irish. It's St. Patrick's Day. So a happy St. Mea's Day. So yeah, your book's been out a couple of weeks now. Talk to me about these different investors. Just give us a bit of a flavor, because are they remarkably similar individuals, or do they have interesting contrasts as people?
All very, very different, and that's deliberate. So I wrote it with my co-author Claire Flynn Levy. And she's important to the story here, because so we've got 12 world-class award-winning investors, from the USA, Europe, globally, and even the best investor in China, John Lin. Okay, so we got talent from around the world, and that's important because depending on where you invest, as you will know, Patrick, you have different things that influence different markets and different approaches at work. So what Claire did is because her firm, she's CEO of Central Analytics, she ran the lens on she analyzed all the tens of thousands of funds out there, got the trade data, everything, and looked at, okay, who are demonstrably good at decision-making execution? Because that's the point of it. We're trying to find guys whose success can be explained by how they've executed their ideas when they're winning and losing. And we, so we got it down to about 73, and then eventually we interviewed a bunch of them, as you can probably imagine, did a lot of interviews, and we got it down to the 12. And these are 12 individuals where we think that you can learn a hell of a lot in terms of how they execute their ideas when they're losing and winning. Each very, very different to another person. You have some, we talked about James Hambry, but so James Hambry in the UK, Greg Badia in the USA, Manish Bajaj in the USA. These people run and hold names for a long, long time, but then you can contrast it and you have someone like, say you're John Lin, or you're, James Nish-Jones or Josh Goldberg. They have a short-term time frame in which they invest, all with very different approaches. And that's important. So because again, there's lots of ways to skin a cat in the market. So we've got people with very different approaches to running money, very different processes, but they all have one thing in common, which is demonstrably proven to add massive value from executing their ideas. So they're assassins when they're losing, and we explore that. What signals enabled you to cut and get out, or what part of your process was it that enabled you to cut and get out? And for some, like you talked about, say Josh Goldberg, who's arguably the best hedge fund manager in the USA in the small cap space, phenomenal investor. For someone like him, he's not prepared to lose more than 1% of the capital of the fund in any idea. So, that alone, that's one of the rules he has. He has many rules, but that's one rule which will get him to get out a loser, for example. And actually, if we stick with Josh and we flip it to, winning side, if you want to be a successful investor when you're winning, you want to be in the tribe of connoisseurs, not raiders. The raider tribe, they're people that make 10, 20% profits, bank it and roll and move on. That doesn't work. From my experience, that doesn't work. All my research, which in the first book showed that doesn't work. But it's what enables you to be in a name and win big. And a lot of people logically think, well, it's time. And we talked about James Hambry earlier, has been in the name 13 years, and that's helped you make 6,000%. But if you have someone like Josh Goldberg, he can make 10x in a name by being in it just 18 months. And part of the reason is he's got this focus on earnings revisions, when he's got a variant perception, and he's also developed over time, interestingly, working with the Central Analytics, because what they do is sports analytics. They help investors make better decisions and better processes. he discovered that for him and his process, holding a name for 15 months is the sweet spot. If he holds them for over 15 months, you'll tend to round trip the name. And so being a buy, if you adopted his approach in a buy and hold manner, it wouldn't be nowhere near as successful as what he's achieved, because he's honed it in terms of maximizing the execution for success. So you get these stories of each of these investors in different parts of the world. Each of them a brief interview on a page on the background, who are they, a page on how they invest, but the big focus is split into two parts for each of them. Case studies on what they do when they're losing, and case studies on what they do when they're winning. And it's meant to be very, it's in a discussion manner, Q&A fashion, and it's meant to be very actionable and very insightful. And that's in a way, that's the new book. It tries to give insights that help your lay investor or professional investor out there improve their game, and means that I don't have to field so many questions via LinkedIn and other manners about what should I do here, what should I do there? Do you think I should sell? Am I winner or loser? Because I get far too many of those kind of emails on the back of the books.
Yeah, and it's always funny, isn't it? I mean, invariably, as soon as somebody thinks you're an investment guru, particularly if you've got a retail audience, they all write to you with very specific clinical exposés of some share. And then they're also surprised that your knowledge of Australian small caps is somewhat patchy, and you don't happen to know that particular sanitation and waste company, which is a remarkably good ESG policy, or whatever it may be. And it's like, yeah, come on, give us a break, guys. I mean, there's 36 or 38,000 listed companies in the world. I mean, even the best of us can't manage to know all of them, let alone all of the 3,000 or 4,000 that are being listed on the likes of NASDAQ or NYSE, let alone any of the other mega bourses of the world. So it's very interesting, though, Lee. So you're providing these great toolkits for people, but telling fabulous stories on the way through. And that makes it really, really gripping. Is there one particular story you'd like to share that kind of stands out in terms of something that you think, gosh, that was really, really insightful or interesting or just sensational?
Well, I guess, each of the case studies, so each of the winning and losing ideas, I think we've put in there as powerful ideas as we can, things that hopefully allow people to learn a lot. And I think we discussed James Hanbury and plus 500 being a massive winner, and the way Josh Goldberg was. But I think, some of the more memorable things are kind of, you're going to learn, you will take little bits from each of them about when to sell, when to hang on and stuff. And I hope it resonates. But what I was trying quite keen to do myself was put a bit of a backstory in there so people can relate and understand and see these people. Because going back to your point earlier, people have a certain perception of what investors are like. And they can't imagine that actually not all investors are like the Wolf of Wall Street or like Michael Douglas. It's not that, in the films, that's not, in Wall Street, the film. They're very different. So, one of the investors, for example, John Barr, one of the most successful US small cap managers at Needham, phenomenal investor, super nice man, does lots of work for charity. And if you look at him, for example, his background, he's from a lumberjack background in Chicago. That's his family business. And you would not know that, because this is a guy whose office is on Park Avenue in New York, pretty much the top location. It tells you how successful the guy is. And you get into it and you go, wow, this guy was a lumberjack. And he goes, yeah. And he goes, actually, the reason I didn't go into it because I was helping the family business. That one day I was driving the truck with a colleague, and I managed to go around a corner a bit too fast, and I dropped all the timber on the road. and he said it was a hot as hell day, and you can imagine trying to pick up these big logs and put them on the back of the truck and everything. And he said after that and a few other things, I kind of realised maybe I won't go into the family business. so that's one thing. Josh Goldberg, who we talked about earlier as well, I think this is incredible. This is a guy in 2016 was given a 2% chance of living from colon cancer. 2% chance of living. He's alive today, cancer-free. But here's the amazing thing. If you had said, when he had told you in 2016, I've got a 2% chance of living, if you had said, that's great, Josh. I'm going to give you all my money to invest. 5 years later, during all that time when he's been having chemo and everything, his hedge fund was pretty much the best in the world. and you sort of go, that just boggles the mind. You're thinking, hold on, this is a guy fighting for his life. They're telling him he's got no chance. How can you have the emotional, mental wherewithal to invest? And so these kind of the things that kind of stick with me, sort of like the stories behind the guy whose process you're gonna read about. But each of them, when you go through the actual stock examples we give, hopefully for the investor, what they'll get from each of them are very different signals as to when they should get out or stay in, and different reasons as to what each of them are looking for to help them, decide what they should do in terms of the name they're invested in. And coming back to what you said earlier, Patrick, one thing they'll realize is the success is not, as you would say, it's not down to, say, a crazy informational edge necessarily or an analytical edge necessarily. The edge is always comes back to execution edge. And a lot of the principles and disciplines that I share in the book, people can definitely sort of rip them out and apply them to the way they run money, if obviously it suits their personality, their philosophy, and that's also why I made sure I put a little page and a bit on each of the investors in there about the philosophy, because the way they execute the names very much is an interplay with how they think about investing. So it kind of goes hand in hand. So see what resonates with you and see what makes sense, and if you think, hey, I could incorporate this into my process to become a better investor, great. If not, hopefully it's an interesting read anyway.
That's a very good point about personalization, actually, Lee, and I'm going to come back to that in just a moment. But we're now already, good grief, 2/3 of the way through our show today, discussing Stock Market Maestros, the latest book by Lee Freeman-Shor, himself somewhat of a maestro in the stock market as an experienced fund manager over many years, building on his previous tome, The Art of Execution. However, one of the things which is always a bit tricky is, of course, that execution risk. And when you're dealing in outer space, execution risk can be exemplified by, well, a multitude of three-dimensional factors. Thousands of Starlink satellites are set to fly lower after a December incident and mounting complaints from, amongst other, China. Here's our Big World short video of the week. Meanwhile, in Big World, complaints from China on a recent incident where a Starlink satellite broke up in orbit during December has resulted in a change of the Starlink orbits to be affected throughout the course of 2026 for around 4,400 satellites, which will go from circa 342 miles above the Earth to a mere 298 miles on average. For more in Big World, like or And that brings us elegantly from outer space, or at least low orbit satellites dropping down to only 300 miles above the Earth, to discussing our book of the week. Last week, of course, it was The Art of Execution by none other than our excellent guest today, Lee Freeman-Shor. Next week, or at least this week's book, is From Manet to Manhattan, a fascinating discussion of the art market from 25 years ago, discussing the rise of the modern art market by Peter Watson. It also happens to be running in sequence, ladies and gentlemen, with a 6-week series we have in the Exchange Invest Weekend newsletter, which is free to read. You can sign up for that at exchangeinvest.com. And hopefully that will produce for you the interesting motivation to move forward and consider subscribing to the water cooler of the Bourse business, the exchange of information, Exchange Invest, which is, of course, the world's unique source, the touch point of ideas, pith, and concepts about the global Bourse business. The global Bourse business itself, ladies and gentlemen, is in mourning this week. I have to add a sad note, a rest in peace towards the man known as MDF, Desmond Fitzgerald, Professor Dr. Desmond Fitzgerald. There was a tribute written this week by myself and his great friend, Danny Corrigan. How to surmise the man who brought together risk management, a great love of things like opera, all manners of polyglot execution in his life, including someone who served the finest French and Italian red wines out of wine glasses that had been sourced from ancient Rome through the auction houses of London, than to say Desmond Fitzgerald, the man who brought modern risk management to the city of London, himself was described at the end of the biographical note to the second edition of his famous work, Financial Futures, something which I think all of us read in the City of London for a generation. And I quote, Desmond Fitzgerald continues to have a passionate interest in the relative speed of thoroughbred racehorses. The delicious contradiction of being an ace risk manager, a master of the Greek alphabet as it was applied to financial markets, and at the same time a lover of the turf. R.I.P. Desmond Fitzgerald, a truly great man. Let's return to our discussion today. We've got a fantastic guest, Lee Freeman-Shor. We're talking about his books, in particular, his book that's just come out, Stock Market Maestro. We left it on a little bit of a tenterhook. So it is very interestingly, isn't it, to go back to where we were in the discussion. There are these innate contradictions, or at least similarities between the way that the different investors work.
Yeah. I think that's the key thing. Although they have different ways of running money, the key trait amongst all of them is that when they're losing, they'll act as an assassin and get out of a position. And when they're winning, they'll run the position and win big. So when we're looking at the thing that binds them, it is their execution side of things. And in a nutshell, if you want to break it down very simply, they make sure they do not ever embrace a left tail. They never lose big. But if they win, they're going to make sure their process allows them to win very, very big. And I can tell you, from the first book, The Art of Execution, a handful of big winners make all the difference to success or failure for a fund manager. You strip those 2 or 3 big winners out, the overall portfolio will be average or pretty poor. So, yeah.
Yes, quite fascinating altogether. So, when we look at these stock market maestros, it's interesting because the one thing that they have in common is they're all different, and they all have very different backgrounds. They all do different things. They approach everything in a different way, but they share a common trait. Not necessarily the same abilities, but they all try to finesse their execution and master their risk quite comprehensively.
Indeed. And that's, another way of expressing, isn't it? Manage their risk. I think more professional way of expressing what I've been saying, Patrick. But, you talked about, we talked about James Hambry earlier with Plus 500. He's made 6,000%. And as you alluded to, and I alluded to, that's a stock that's been very volatile along the way. So you go, how the hell do you manage your risk and stay in that name? And, forget about, how do you not make the mistake of taking profits too early? How do you manage to stay in and weather it? And if you look at someone like James Hambry, who's a phenomenal executor of ideas, one of the things he will do is he will move incrementally. So he'll adjust the position size, by say 50 basis points each time, so 0.5% every time, and directionally. So if so something like Plus 500, you would have seen it at its low points being maybe as low as 1%, and its high points maybe being as high as 9%. And when the risk is getting a bit too high for him, what you'd see him doing is you'd see him reducing. If he had a 9% position, he'd start reducing it down, but he'd do it gradually. 9 down to 8.5 to 8 to 7.5 to 7. He'd do it in that kind of mechanical or method approach, because he's discovered. And it shows how phenomenal, how introspective he is. That's the easiest way to emotionally handle taking some chips off the table, effectively taking some profits. Because you and I know, and he knows, oftentimes emotionally you want to do the wrong thing at the wrong time. So if you move slowly, it sort of hedges you against. Where you think you're doing something for information reasons and rational reasons, it just hedges you against your emotions dominating and you doing something which could have serious consequences. I think that's one thing, where some people go wrong. They'll go, I've got this big position in this name. It's gone up a lot. Just sell everything and move on. And that's what gets you out of the massive winners, because
yes.
You kind of and what he's showing is and that in behavioral finance terms, it's called the disposition effect, where you take profits too early, and also Daniel Kahneman of blessed memory, who passed away recently, Nobel Prize winner. He also alluded to prospect theory. how we feel as well changes when we're winning and losing. So your feelings and your disposition when you're winning is to just bank that profit. And invariably, if you do that, you do it too soon, you're never going to have a big winner, and you need to embrace the big winners. And that's something we can learn from, someone like James Hambry and the other guys in the book that do it very well. Manish Bajaj, Greg Badilla, all phenomenal guys that do that well.
And actually, one of the things I've often found, and maybe you did too, so I'm interested because you've been talking to a lot more stock market maestros recently than I, is actually quite a lot of these investors are more stressed when they're winning in a certain way, because that actually requires more finessing and management than actually losing money is kind of easy in that, that's what you're going to lose. That's where you're going to sell out. You've got a very, very simple playbook. But once the thing actually starts to work, and that's why it's fascinating to hear you talk about, for example, timeframes where you've got investors saying, oh, well, I know that roughly about 15 months is actually the time window when I've got the best out of the investment. But it is intriguing because watching sometimes these investors, they can appear relatively stressed, and you look at their numbers and you suddenly realize that they're actually putting on alpha beyond belief. I mean, they're not even having a good quarter. I mean, they are outperforming the market, but that's actually putting them under duress.
Yeah. I mean, I give you a good example. I mean, someone I've known for a long time, Dirk Enderlein. He's a guy that was part of my team, my setup. If you go back to 2011, I was on public record saying he's the best investor in Europe, in growth, full stop. And he is. I mean, you look at his numbers today, some 15 years later, he's number one by a mile. He's the guy that delivers 5% plus alpha on the long and the short side. Wow. He's just an incredible investor. But what I used to like with Dirk is he's so introspective, and he's a student of financial history. So if he'll go back and he'll look at the 20s and 30s and the Nifty 50 period in the 70s, trying to get his head around, if you like, extreme market environments, when he thinks market environments are extreme. Because, when he's fishing in the growth category, some of the names he gets in, on the face of it, you could go, wow, this is expensive. But he'll be going, well, is it expensive? Let's have a look at what this type of name has traded for historically in its own right. And this type of category of company has done in various periods in time. And you can see him sometimes, he'll be going, he's wrestling with that. Is it too expensive? Is it not too expensive? But what he does very good, he's very clear, is that because he's done all this work going back through decades of history on names and types of companies, he will know when it gets too uncomfortable. And that is when it goes, what he'd say is outside of the valuation box. So you have the stock is expensive, and everyone say it's expensive, but his gift is he'll go, yes, it's expensive, but when others are selling, I'm staying with it because I've done my work on how expensive this can get and when it's abnormally expensive, and he'll stay in he can stay in an expensive name until it jumps outside that valuation box where it's extreme, and then he'll go, look, no time in various market regimes in history has this kind of multiple ever been justified for this type of name. Therefore, it's time to get out. But the key point with him is that approach of his, by taking into account the value side, not just the growth story, which I think a lot of growth investors get wrong, is it allows him to ride a winner for a long, long, long time, but also be aware of when things are extreme from valuation perspective and get off. And a lot of people get out a lot of people either get out way too early or they won't get out at all. And he sort of finessed it beautifully in terms of, when you should be thinking about, getting out or chopping the position right down.
It has to be said, due to various factors at this juncture, Lee, I'm patently aware of the fact that we should have to finesse this interview somewhat delicately. We could carry on for hours. It's really, really fascinating discussing the art of execution, discussing stock market maestros. You've given us so much headline information to deal with, but I'm aware for various reasons the time is pressing on. So I'm going to ask you that question we ask every guest at this stage in this show. Lee Freeman-Shor, author of Stock Market Maestros, where do you think the capital market revolution goes next?
Oh, crikey. Why do you have to ask me? Capital market revolution goes next. Well, not really a big picture guy, but if I had to look at what's going on out there, I would be probably saying that a lot of assets or real world assets will find their way onto the blockchain. And I see some of the big players doing that, BlackRock, iShares, etc. All these, a lot of. So I think that would seem logical to me because it deals with a lot of custodian issues and things like that. I mean, I'm probably going to the plumbing a bit too much here, Patrick, and boring the hell out of your audience. But I think probably, the architecture of financial world changes, and I think the blockchain makes a way or presence in there going forward. So for someone like you and me, I'm not sure it affects maybe how we'd do things because we'd probably still have our investment accounts, but instead of having to open a crypto wallet or something, we could probably just, I'd imagine in the future, just through our investment account, invest in something, probably not even knowing that it's being handled on a blockchain. But if that's what I'd probably suggest, I think, as opposed to start arguments about passive versus active investing and stuff like that. But is that okay?
Sounds fabulous. Sounds absolutely inspiring altogether. And I think one of the things very interesting about that is certainly whatever way it goes with tokenization, with real world assets, it's going to expand the universe of investable items and in favor of things that are actually tangibly investable rather than necessarily pixels for the sake of pixels. And that's got to be a very, very interesting aspect for the investors overall. Lee Freeman-Shor, it's been an absolute joy chatting to you today. We hope that you will be able to come back to us next time, and we'll also have a more peaceful environment in Israel and around you, which will be important because let's face it, it's St. Patrick's Day today. And obviously we have to therefore, as you're in Tel Aviv, say hello to a member of the Irish diaspora, none other than your president, Mr. Herzog, whose own father was born in Ireland, actually in Northern Ireland, the province I come from many, many years ago. One of the many people we in Northern Ireland regard as our 10 most famous sons for dinner party conversation to confuse people. A happy St. Patrick's Day to everybody. RIP to Desmond Fitzgerald once again. Coming next week, ladies and gentlemen, we've got another fantastic, really a show you cannot possibly miss. We will have the former CEO, the woman who revolutionized the market in Kingston. Reflections from Jamaica is going to be with Marlene Street Forest. That's going to be IPO-VID 206. This has been IPO-VID 205. I want to say a big thank you to Kim, Racy, and also Marianne for their great work in production. Most of all, go out and get yourself a copy of at least Stock Market Maestros. And actually, I would also go get the execution book too, because The Art of Execution already been our book of the week and it's a must read. Lee, it's been a pleasure. I look forward to speaking to you again in the near future. And I wish you every success with your latest book. Thank you for watching, everybody. I wish you all a great week in life and markets. And let's hope that we'll soon be able to talk in a more peaceful world. My name is Patrick L. Young. See you next week.